As the new school year approaches, families are busy with supplies, schedules, and tuition bills. But there is another important task to add to your back-to-school checklist: planning for education-related tax benefits. Organizing your records and understanding the latest tax rules now can help you avoid missed opportunities and make tax season much smoother when it arrives. Education tax rules can be confusing, with different benefits applying to different situations. Some tax breaks are designed for higher education, others for student loans, and some depend on state rather than federal law. The key is not to assume every school expense qualifies for a tax benefit. Instead, it is important to know which expenses matter, what documentation to keep, and when to seek professional guidance. One of the most valuable federal education credits is the American Opportunity Tax Credit. This credit is generally available for the first 4 years of post-secondary education for students pursuing a degree or recognized credential. According to the Internal Revenue Service, or IRS, the maximum credit is up to $2,500 per eligible student, and qualified expenses used to calculate the credit cannot exceed $4,000 per student. The Lifetime Learning Credit is another important option. Unlike the American Opportunity Tax Credit, it is not limited to the first 4 years of post-secondary education. It can apply to courses taken to acquire or improve job skills. The IRS states that the Lifetime Learning Credit can be up to $2,000 per tax return, calculated as 20% of the first $10,000 of qualified expenses. Documentation is critical when claiming education tax benefits. Schools typically issue Form 1098-T, tuition statement, to help determine potential credits. However, the amount on Form 1098-T may not match what was actually paid or what is eligible to claim. Families should keep their own records, including billing statements, receipts, proof of payment, scholarship details, and course material documentation. Be careful not to double dip. The same expense generally cannot be used for more than one tax benefit. Expenses used to claim an education credit may need to be coordinated with scholarships, grants, employer assistance, or 529 plan distributions. Back-to-school planning is a great time to review 529 plan activity. Beginning in 2026, federal law expands 529 plan flexibility for K-12 education. The annual federal limit for qualified K-12 expenses increases from $10,000 to $20,000 per beneficiary, and qualified expenses expand to include books, curriculum materials, online educational materials, and more. Student loan interest is another area to review. The IRS allows taxpayers to deduct up to $2,500 of qualified student loan interest, subject to income limits. Also, note that broad federal exclusion for forgiven student loans generally applies through 2025. After that, some forgiven loans may become taxable unless another exclusion applies. Educators can still deduct up to $300 of unreimbursed classroom expenses, or up to $600 on a joint return if both spouses are eligible educators. Starting in 2026, those who itemize may also deduct qualifying unreimbursed educator expenses above that amount, subject to applicable rules. To stay organized, save tuition bills, payment confirmations, and Form 1098-T track scholarships, grants, and 529 distributions. Avoid using the same expense for multiple benefits. Keep receipts for required books and supplies. Organize records by student and school year. If you are unsure about eligibility, seek guidance before filing. Planning now can help you maximize your tax benefits and reduce surprises at tax time. Make sure to subscribe to stay up to date on all of ARI's tax tips. At ARI, we appreciate all feedback. Please consider leaving us a like, comment, or a share, and we will see you in the next video.